Hi, welcome to my channel once again. I'll be talking about the third aspect of our topic under working capital management, that is determining working capital needs. It's not far-fetched from what we've been discussing over time on working capital. So the syllabus wants us to look at the length of the working capital cycle in terms of trade, which are some of the things we've talked about over time in the class and in some of the videos I've posted on my channel. So talking about working capital, that's this represents the liquidity a business needs for day-to-day operations, and it is calculated as current assets less current liabilities. So in simple terms, you can say that working capital shows whether a company has enough short-term resource like cash, receivables, and inventories to cover its short-term obligations like payables and short-term loans. So it is very important for organizations to maintain the right level of working capital because this is crucial to their survival. So business organizations must note that too little can lead to difficulties in paying suppliers and employees. There is too little um, working capital can lead to difficulties in paying suppliers or employees, while too much of working capital can mean that funds are tied up in idle cash or idle assets instead of them being invested for growth. So the appropriate level depends on the size and composition of current assets. For example, how much is held, how much is held in inventory versus how much is held in cash. So this is very important. This is very important. Also, how those assets are financed, whether through short-term liabilities, long-term funding, or a mix of both, is also crucial. So talking about the the length, talking about the length of working capital cycle and terms of trade. Talking about the length of working capital cycle and terms of trade. The working capital cycle shows how long it takes for a business to convert cash spent on raw materials into cash collected from customers. So it covers three main stages, that is paying suppliers for raw material, producing and holding inventory, collecting receivables from customers. Now, we must note that a longer cycle means cash is tied up in inventory and receivables for a longer period. So increasing the need for working capital. So when your cash is tied up in inventory, it means there will be more need for working capital, while a shorter cycle frees up cash faster, hence reducing your financing needs. So when your working capital cycle is very short, it means you will have less problem in requesting for cash from external sources. So talking about terms of trade now, the terms of trade, that is the credit terms agreed with suppliers and customers, directly affect the cycle likewise. A favorable term, such as longer credit from suppliers or shorter credit to customers, help reduce working capital requirements. So unfavorable terms is a situation whereby we have short supplier credit. The supplier is giving us a little time to pay. So in this regard, there is long customers credits. Hence, we are giving the customer much period for them to pay us back. So this increase the amount of working capital need. It shows that the supplier is giving us less time for us to pay their fund. And we likewise as a business, we are giving longer time to our customers. So this is an unfavorable term. So for example, if a firm allows 60 days credit to customers, but receive only 30 days from suppliers. It must fund the 30-day gap using its own resource or borrowing, thereby increasing working capital need. So this is an issue that organizations have to look at. Likewise, also we have working capital policies. We have working capital policies. We have various policies such as conservative and aggressive policies. Yes, conservative and aggressive policies. Now, when we talk about these policies, business manage working capital using different approaches, each with trade-offs between liquidity and profitability. That is, each of these has the opportunity cost. When a business is using conservative, there's an opportunity cost they are forgoing for not adopting the aggressive policy. When a business is using the aggressive policy, there is an opportunity cost that is being forgone for not using the conservative policy, for not using the conservative policy. So the conservative policy, it maintains high levels of current assets, such as larger inventories, higher cash balance, and so on. And some of the advantages that it reduces the risk of running out of stock or cash, because it also ensures smoother operations. That is when you use the conservative policy, you maintain high levels of current assets. So you won't run out of stock even when it is the peak period of your sales. The disadvantage is that it ties up funds and increases costs. So you have too much inventory, too much of your money tied up in inventory. So this results in idle cash earning low returns. For example, you can have a case of a supermarket holding 3 months of stock to avoid shortages, even though it pays more for warehousing. So this is conservative policy. While the aggressive policy keeps minimal current assets, so relying on faster inventory turnover and tighter cash control. So some of its advantages is that it frees up cash for other uses. So instead of you tying up your cash in inventory, this helps to improve profitability through lower holding cost. And one of its disadvantages is that it increases the risk of stock out because you are not keeping much stock in your warehouse. So when there is much demand, you run out of stock. So it increases the risk of stock out or cash shortfalls. For example, a tech retailing uh, holding company, for example, a tech retailer can only hold only 2 weeks of stock to cut costs of warehousing, but it risks loss of sales if demand uh, is high, if demand spikes. So this is one of the issue organization must look out for in terms of working capital likewise. So there is a need for us to look at balancing liquidity and profitability, balancing liquidity and profitability as it regards to working capital. Now, the point is this: the optimal policy depends on the firm's risk appetite. Now, if the firm is a risk lover, their approach will be different. So, industry's characteristics and access to financing is a function of the balancing effect between liquidity and profitability. So striking the right balance ensures that business stays solvent without sacrificing returns. So also industry difference. Industry difference is a factor. Is a factor. The industry in which the organization operates is a factor in determining the working capital needs. So working capital requirements are shaped by how business operates in different industries. For example, a retailer, let's use the supermarket as an example. Let's use the supermarket as an example. Now, a fast inventory turnover is also often common with a supermarket, and also customers pay immediately, and suppliers often provide credit. Yes, to supermarkets. Their customer pay immediately for goods, inventory move very fast, and they can get goods on credit from suppliers and pay back after a week or months. So how does this affect the working capital? It means that less cash is tied up because sales generate cash quickly. So a supermarket might sell goods within a week, but pay suppliers after 30 days, meaning it's often operate with negative working capital, that is, using the supplier's credit to fund its operations. So also, we can talk about the construction firm. One of their features or their characteristics is that there, there is long-term or long project cycles, significant upfront cost for materials and labor, and there is most times delayed payment from clients. Yes, these are features of construction firm. And the impact on working capital is that large amounts of cash are tied up in work in progress and receivables. You can see construction projects being in a state of work in progress for over months, for years, maybe due to cash and non-availability of cash and the rest of it. So the point is this: a construction company may spend heavily at the start of a project, but only receive payment months later, requiring what? Requiring more financing to sustain its operations. So also we can have businesses which are peak periods are seasonal. So seasonal businesses, we can have toy businesses and toy manufacturers, farming. Yes, the futures of this form of business is that demand fluctuates throughout the year, and there is an impact on the working capital of organizations that operate in this type of business. So there is need surge during peak production period, but fall during off seasons. So a toy manufacturer may build up inventory months before the peak period, let's say December, tying up cash until holiday sales generate revenue. So these are some of the industry specific issues that affect working capital, Now, let's talk about working capital funding. That is choosing the right sources. That is the relative cost and risks of short-term and long-term finance. So managing working capital isn't just about how much to hold. It is also about how to finance it. So businesses typically use a mix of short-term and long-term funding. So it depends on the nature of their current assets. So in this, we can look at the issue of permanent and fluctuating current assets. Permanent and fluctuating current assets as regards this. Now, when we talk about the permanent current assets, the minimum level of current assets a business needs to operate continuously is the permanent current asset, such as the baseline inventory and receivables that are always present. For example, a bakery always keep flour and sugar on hand, regardless of season. While when we talk about the fluctuating current assets, these are assets that rise and fall with business cycles or seasonal demand. For example, an ice cream producer builds extra inventory in summer but reduces it in winter. So the permanent current asset is the minimum level of current asset a business needs to operate continuously. While the fluctuating current asset, these are assets that rise and fall in relation to season. In relation to season. So also we can have issues of matching fund sources to asset types. That is the matching principle. The matching principle. Now, the matching principle, what does this entails? Now we have permanent assets. For you to finance your permanent assets, you need long-term funding. So long-term assets should be financed with long-term finance. So using equity or long-term debt provides stability and avoid the risk of frequent refinancing. So in relation to this, In relation to this, just as you wouldn't use a payday loan to buy factory equipment, you shouldn't also rely on short-term loans to finance the inventory you always need. Yes, that is one thing about that. So you must match long-term assets with long-term finance. So also we have fluctuating assets. You have to match fluctuating assets with short-term funding. Short-term loans, overdraft, or trade credit are cheaper and more flexible, so making them suitable for temporary spikes in working capital needs. So it is very clear. It is like using a credit card for seasonal expenses. You can pay off quickly. So the point is this: organizations, businesses have to choose the right sources to finance their working capital. So, because managing working capital isn't just about how much to hold, it is also about how to finance it. So, business typically use a mix of short-term and long-term funding. So, as I've said, the permanent versus fluctuating current assets, businesses must match their need with their with the source that suits the need. So this is very, very much important for business organizations. So also talking about the relative cost and benefits of funding, the relative cost and benefits of funding of business. Now we have the aggressive policy, the conservative policy. We have the matching policy. So also this table you can see it's showing a summary of the relative cost benefits of funding policies. Now, the aggressive policy, what does it do? It uses short-term finance, even for what? Even for permanent assets. That is what the aggressive policy does. And the cost is low because it's short-term, but the risk is high. The risk is high. When you're using short-term finance, short-term source of finance to implement a project that is of permanent nature, it is very risky. The risk is high. The benefit is lower interest costs and higher returns since you are using short-term finance. The conservative policy, what does it do? It uses long-term finance even for fluctuating assets. The cost is high because you're using loans, bonds to finance such. So the cost is high, but the risk is what low because it is spread over a long period of time. The benefit is greater liquidity and safety. And also you have the matching. This aligns funding duration with the life of the asset, and there is a moderate cost, and the risk is also moderate, and the benefit is what? There's a balanced cost between cost and risk when you talk about the relative cost of the asset. So these are some of the things that we're expected to know regarding the third aspect of the syllabus with respect to determining working capital needs. So you must note that the aggressive policy relies heavily on short-term finance, and this leads to lower cost and higher returns, but with higher risk. And the conservative policy uses long-term finance even for short-term needs, offering greater liquidity and safety, but at a higher cost. And also the matching policy aligns financing with asset life and balance cost and risk. So these are things we must take note of. Take note of even while we study further. Thank you very much for listening.